All right, this is Market Pulse. Right now, we're picking up the pulse of the day with Samuel Oyekanmi. He's a research analyst at Norrenberger. It's great to have you in, Samuel.
Thanks for having me, Joanna. Good afternoon.
Good afternoon. So we're going to begin with the focus on inflation data. The latest inflation data, some are saying the decline to 33.4% could lend some sort of relief to the CBN when it comes to further rate hikes. Do you see equities becoming less attractive as a result? And for you, what are the implications of this data for the investment space?
Yeah, highly possible. The numbers are really in line with projections that we're beginning to see some level of moderations in the second half of the year, and that's what we've seen. But in terms of what it might also play out for investors or the investment landscape, we expect that this might serve as some form of respite for the CBN to probably pull down or reduce some of this aggressive hawkish stance so far the year. The CBN has increased interest rate by about 800 basis points already. One would expect that with inflation starting to moderate, the CBN will probably hold, or maybe at some point later on in the year, see some form of dovish stance. But as it stands, we expect that a number of funds will be moving from the equities market into the fixed income space, because the expectation now is that the high yielding instruments that we've been seeing over the last couple of months might start to plateau going forward. And what you expect is that investors will start to lock in some of these those long-term high-yielding instruments, or at least they would have locked in their investment, or at least located their portfolios in such a way that they have this high-yielding instruments with them. So, of course, that might have some negative impact on the equities market, but is that enough to erode many of the gains that has been recorded in the last 7 months? I don't think so. But the market might seem unattractive in the short term as many of them try to reallocate and lock in some of those high yields.
And I mean, when you say unattractive, are you also saying to investors on the global front, on the international front?
I think it's general. The same way it plays for the players in the equities market, foreigners, the same way it also plays to domestic players. But of course, in their own stead, they also want to look at the Feds. When would their Feds be reducing interest rate? Will they be holding the expectations that the next Fed's meeting they might be reducing interest rate? And if that happens, then it also influences whether or not foreign players move their funds into Nigerian equities market or even the fixed income market. But as it stands right now, it's a trade-off.
All right. I mean, all eyes on the decision from the bankers of the government, right? The CBN. But speaking of, decisions, from the CBN has incurred interest costs in the first 6 months of this year. That is 654.7% higher than the amount recorded for the first 6 months of last year. That same period. Now, coupled that with having the largest T-bill debt on record, should warning and alarm bells be going off here? I mean, do you have concerns?
Even before now, the level of debt for the Nigerian government, either through the DMO or through the CBN, has always been a cause for worry. Although we would always quote our debt to GDP ratio as saying it's still substantially lower compared to other economies. But when you look at the debt to revenue generating, that's significantly high. Even at some point, you realize that debt service cost is even more than the revenue generated at the end of the day. So, of course, there's always that worry. But is it out of our own covers? Is it out of our own reach? I don't think so. There's always ways around it. The government has always found a way to survive around it. Our debt body is around 120 trillion right now. Probably going to be getting us around 130, 140. And it's quite expected, because for you to attract some of these foreign hot dollars into the economy to ensure the stability of the exchange rate, you needed to increase your interest rates significantly to incentivize foreign players to bring in their portfolio investments into the Nigerian economy. So it was expected, right? I don't think that's going to be it's going to have significant impact so much on the economy. I think there's pretty much always a way around it. But yes, debt problem has always been an issue it doesn't seem like it's going to stop anytime soon.
And so there's always a way around it. It'd be interesting to know what ways, they find around this particular issue. But looking into the week ahead, right, and still in line with, debt issuance and all of that, the federal government is set to issue its dollar-denominated bond. It's the first of its kind next week, Monday. How do you predict this outing? How do you see it unfolding, considering we're already witnessing some sort of moderation in investors' appetites for debt securities of late?
It will be interesting to see how that plays out, and then it gives us a sense of how much FX liquidity we do have in Nigeria, aside from the fact that we also have Nigerians abroad who are also who could also invest or invest in this bond. But it would really be interesting to see how it goes. The government has said that the bond is going to be benchmarked around Euro bonds, 5-year Euro bonds, and that's around less than 10%. I think it's going to be around 10% eventually, and that might be incentive enough for a number of players to want to invest in there. And especially when you look at the fact that interest rate might begin to start moderating downwards, you probably want to lock in some of those long-term instruments that have high yields at this point in time. So I think it would be largely subscribed. I don't know if it will be oversubscribed, because then again, there's still the factor of FX liquidity in the system. How much FX do we think we have in the circulation for us to be able to meet up with 500 million? But aside that, if you were just looking at the interest rate, the yield investment for people, I think it is incentive enough compared to Euro bonds and other instruments.
All right, we'll see how it pans out. Of course, that they have said they're targeting that about, is it $30 billion in domiciliary accounts here in the diaspora. So we'll see how this all unfolds. But thank you so much for joining me, research analyst at Norrenberger, Samuel Oyekanmi. It's a pleasure having you join me.